Howdy, Jacob here. Today we're looking at Cintas Corporation. It is in the commercial services and supplies industry, over 60 billion market cap, been around since 1968. So the company's growth is not immense, but pretty solid. So 4.2 billion in revenue in 2014 up to 8.8 billion in 2023, so over doubling, with both margins, gross and operating, increasing from 42% to 47% on the gross margin side, and then 14% to 21% on the operating margin side. Return on invested capital also growing from 11% to 21%, pretty substantial there. The balance sheet has a little bit of debt here, 2.5 billion in long-term debt, with only 124 million cash on hand. So there is a good amount of debt there, but in relation to cash flow, let's say 2.5 billion, it's less than 2 years. So on a 5-year average basis, well, just a little over 2 years, because let's say they make 1.1 billion 5-year average, that 2.5 will be done and paid out. That 2.5 billion could be paid off in just over 2 years. So from the debt perspective, not concerning. Pretty healthy balance sheet there. Their use of cash is a little bit of acquisitions, a lot of share repurchases, and then a good amount on paying out a dividend. And so we see that, let's say that, well, the dividend payout of 450 million or 491 million in the rolling 12 is less than 50% of their 5-year average. And so the dividend can be paid out easily. Their common share repurchases is about 50%. So really we're looking at, on average, about 40% payout on the dividend, probably 40 to 50% payout on the common stock, and then the remaining 10% really a mix between paying down debt, acquiring companies, and then reinvesting back into themselves. Let's start making some assumptions here. I can see that their P is 44, so, and the growth isn't immense. So I already have an inkling that it'll be probably a little bit expensive. But let's see, this dividend, they've increased it pretty substantially, and they can afford it. So let's say that they grow their dividend 10% a year for the next 7 years. Revenue side, they could probably grow. Let's do 7%, 18 on the P in price of free cash flow, 15% return. Let's do 15, 14. Okay, and then share change. Let's say they buy back 1% of shares. Yeah, that makes sense to me. So the current price to their earnings is just pretty substantial at this point, and they're not outgrowing it in the fact of, I'm looking for a 15% return, and their growth rate is not 15%. And I just believe 40 is just an absolutely ridiculous P, given their current growth rates and such. I think that, I'm not saying a 40 PE company, I wouldn't buy a 40 PE company, but you just have to understand, if you are going to buy a company that has this immense value to it, the return has to be pretty substantial on both the revenue and the earnings side. And so, yeah, the revenue just over doubled while their earnings per share went up 400%. That's great to see. Or 300%, it's pretty substantial. But whether they do that over the next 7 years, I just don't know if I see that. So for me, it's just a little frothy. But definitely a fantastic company from the numbers perspective, and one that I want to own in the future, just not at these prices. So hopefully you enjoyed the video and have a great rest of your day. Thank you.